Good day, everyone. Ali Safi here from Safi Financial Network. In this video, I'm going to just show you the bigger picture of the stock market and how cycles are going to work for the next few years. So right now, as you know, stock market had a fantastic rally in 2020, 22 bottom, 23 was pretty bullish year, 24 was okay, still we are pretty close to new all-time high. We broke the record. Everyone was waiting for a crash in 2022, 23, 24, but it never happened. So are we gonna just keep grinding higher for the next few years, or we are reaching to a cycle top based on the cycles, 40-year cycle, 17-year cycle, or 14-year cycle? So in this video, I don't want to go through all the cycles. I just want to show you some charts that they are just kind of like a screaming. We may head into a rainy days or cloudy days in 2025, 2026. So bear with me until the end of this video because it's going to be very simple, but I should say it's going to be more informative. So first chart I want to show you is yield curve. So as you see here, this is the 10-year bond minus a 2-year bond, which is kind of like a medium minus short-term bond. And as you see here, yield curve just inverted in 2022. And it went down, one of the deepest actually inversion that we have seen in the history. Usually when we see inversion, we are kind of like getting ready for recession. So the last time was 2006 to 2007, yield curve was inverted. And when it's getting uninverted, we are heading to the recession. The same as 2020. So yield curve just in 2019 got inverted, but sharply bounced back up. And in 2020, we got COVID crash. And that was kind of like a very, very, I should say, short recession for the stock market. Right now, we are just heading into another, I should say, a big one, because look at the inverted kind of like a phase or scale that we can see. And right now, I should say, yield curve is getting back to the upside, which is getting uninverted potentially early 2025. And this is kind of like a recessionary signal, folks. This is very, very important signal. The last time we got it, was kind of like a 6 months before recession in September, and in February, as you know, we just dump into recession. In 2028, when we got inversion, it was May 2007. And you know, market just crashed in September 2007 and start going down all the way to March 2009, which was yield curve was at its top. So when yield curve is at its top, usually this is going to be a stock market bottom. And right now, I should say we are going to just head for another bigger recession is coming, potentially early, I should say 2024, 2025, we can see kind of like an inversion. And then we are heading to 2025, 2026. I should say recession is coming in 2025, 2026. It's going to be very, very foreseeable scenario. I'm not looking at like a chairman's, Federal Reserve chairman's about like a soft landing or there is any landing. We're going to just keep grinding higher. I don't pay attention to that because this is a very, very obvious to me that this chart tells me that next few years are going to be rainy years. Also, if we just look at the bond yield, I'm going to show you the bigger picture of the bond yield, and I'm going to compare it to the last few years. So this is the bond yield. And as you see here, we just got into kind of like a bearish momentum. And this is a very nice head and shoulder, which is kind of like a bearish pattern at the top. And we just broke this neckline last month. And we are kind of like having a dead cat bounce, and potentially we're going to get back down. So if we get below 3%, 3.81%, we're going to see have like a sharp sell-off all the way to here, which is a 2.4 to 2.6%, potentially a bounce for another sharp sell-off down here. So last time when we got here was 2000. Look at that. So here's the top information, intermediate top, going down. But before that, in 2008, if we just look at the market, 2007, we got picked as we picked in, as we kind of like a bottom in the yield curve in 2007, May 2007. September was kind of like a hard, very, very hard kind of like a month for yield curve. And here is the breakdown, which is, if I want to show you exactly what was the date for that one, we can just refer to this area. So this is July 2007, where we broke this pattern to the downside. So this is kind of like a leading indicator. This is not lagging. This is leading indicator, because in September, we got Lehman Brothers bankruptcy, and that was kind of like a beginning of recession in 2007, all the way to 2009, when we got kind of like a stock market bottom. So this is kind of like an interesting scenario, because when yield is going to go down, bond yield is going to go down very fast. It's not going to be like this, or it's not going down like this. It's going to just a sharp sell-off, just because we are heading into recession and everyone is kind of like cutting the rates. Everyone's talking about cutting the rate, and Federal Reserve is going to cut the rate very, very, very soon and very sharp. So they are not going to go with 25, 25, 25. Potentially, they're going to just bring the rate down 1%, 1% after each other if we hit a recession, which is going to happen potentially in 2025, 2026. Those years are going to be very, very ugly years for the market, and everyone needs to be kind of like careful about that. This is kind of like the first chart, and second chart that I want to say. So this is a weekly chart, but I should say we are very close to the breakout. So if we break down nicely to the downside, we are going to just sharply going down, and 2025 is just going to be 5 months ahead of us. The next chart I want to show you is Treasury bond. So 10-year Treasury bond. And as you see here in the stock market, when stock market crashed in 2001, 2002, so we just got a bottom here, moving to the upside. Here is the scenario in 2008, 2007, when bond is start to going higher, when the stock market is picking, bond is kind of like forming the bottom. Right now, we are at the bottoming formation for bond. So this means the stock market is at extreme top and bond market is at extreme low. So this is kind of like a nice W pattern, 2007, 2009, and look at that, because bond yield is going to go down, bond price is going to go up. So this is kind of like inverse correlation with each other. In previous slide, I show you bond yield is going to go down. So this means bond is going to go up, stock market is going to crash, just because everyone's piling money into bond, and bond is going to have a fantastic performance. I should say bond can reach out easily to 130 for the maximum level. However, 120 is going to be kind of like a hiccup, but 130 is going to be the maximum level, potentially at the bottom of the stock market crash. So these three charts are telling me that 2025, 2026, those years are going to be very, very ugly, cloudy, maybe rainy, snowy days or years. So what's your comment? What's your idea? I'm really interested to see what's your idea about the stock market and about these charts. Let me know what's your idea down below, and I'm going to answer all those questions or your comments. Have a fantastic evening, guys. See you on the chart. Bye-bye.